So this is our last week of European financial markets for the semester, and I thought I would do a kind of a bigger current events segment. I'm going to try not to make it too long because I realize you guys have a lot of other stuff on your plates, but I thought it would be fun for us to focus a little bit on what's going on in Italy and with the recent European Council Summit that took place on the 23rd of April. So what I'm going to do is break it down into 5 questions, which is, what is happening in the Italian economy? It's helpful that yesterday we got the economic and financial document from the Ministry of Finance, so we have their official provisions or what do they call it, estimates for what's going to happen in the future. The second question is what is the ECB doing to stabilize the markets? Once again, we've had another week with a significant ECB intervention, so we'll talk about that. What did the European Council add in the mix? How did the markets and credit rating agencies respond? And then we'll finish with what all this means for Italy and by extension, the future of the euro. All right, let's start with the bad news. And the bad news comes from the official estimates that they've baked into the economic and financial planning document that they had to report to the European Commission. Now, the first number I want you to focus on, PIL in Italian is the word, the acronym for GDP. They are expecting in 2020 the GDP to go down by 8%, which is a really big drop for this year. And then they're expecting a significant, but still relative to decline, modest recovery in the next year. That's pretty bad news, and I believe that is going to turn out to be an optimistic assessment. But for this document, I think it's a realistic number for them to include because the best information they have right now reflects that, even though I'm sure they're going to have to revise it later. The other number I want to point you to is the increase in unemployment. They think they can keep unemployment from increasing beyond 10 to just 11.6%. A lot of that is going to depend on how well they are able to maintain the hotel, restaurant, and catering sector without a tourist population. But I think we're going to have to look at that. Anyway, these are pretty realistic numbers for this kind of an exercise, government planning exercise, and they paint a very depressing picture. And when we dig that picture down into more detail, it tells us stuff that are directly related to financial markets. Now, I brought this big detailed picture out, not because I want to go through the whole thing, but because I want to point to something I've actually never seen before. And I don't mean to chuckle when I say that, it's just so striking. Look at this number. The PIL, again, is GDP. It says nominal GDP. Nominal GDP in 2019 is 1.8 roughly trillion euros. Nominal GDP in 2020 they're expecting to be 1.7, actually lower, right? I've never actually seen nominal GDP contract. I've never seen it contract by so much for a country. So that is a really bad little detail. Even worse detail, this is the line is indebitamento netto, which is net indebtedment. This is the net new issue of debt that they're going to have to do, and that is 118 billion euros that they've got to pull out of the market somehow during the course of the year. That is a huge number. So if we're worried about Italy, I think these planning documents give us a good reason to be concerned. So what is the ECB doing? Well, part of the response was known already at the start of the week when they announced the cumulative spend in the pandemic emergency purchasing program through the week prior, which was topping out at about 70 billion. That's a big number. That means they spent 20 billion last week. I think we're going to have to look again at how much they spend this week. The big addition they made was to freeze the eligibility of assets as per their credit rating on the 7th of April. Now, what that means essentially is that Italy, which is 2 steps above junk status with a BBB rating, if Italy were to fall below its rating right now, Italian banks would still be able to use Italian sovereign debt as collateral. That's super important because it stops Italy from facing a cliff edge where the Italian banks from one day to the next suddenly lose access to a significant amount of the assets that they were using as collateral for central bank liquidity. So this is a really big and important move by the ECB. Having said that, you really need to look at the bottom of this list. What they're telling us is that the Italian banks will be able to use Italian sovereign debt as collateral, but when they do, they're going to get a bigger haircut because the haircut is not frozen at whatever the rating was on 7th of April. The haircut actually is going to increase as the ratings decline. So we still have to be very concerned about the ratings because of what it'll mean for the cost of funding for the banks that are involved and that are seeking liquidity from the central bank. Daniela Gabor is the one who pointed this out in Twitter, and she said, look, they've stopped the cliff edge, but they've still given us a balcony effect, and I'm still not quite sure what that means, but I suspect it's like when the guy falls off and falls from one balcony to the next, rather than falling all the way off the building and splatting on the pavement. So it's a good thing, but it's not saving us from everything yet. The other thing that the ECB did, and I think this is noteworthy, is that Christine Lagarde, the president of the ECB, actually went to the European Council and said to them that they're really doing too little, too late. They need to get their game up and push forward. And that kind of jawboning is what she had promised to do when she interviewed with the European Parliament for this position. It's a job she's uniquely suited to do because she's been a finance minister in the past, and in addition to having been managing director of the IMF. And it's something that I'm very glad to see her do. Whether it will have any effect remains to be seen. But the ECB is playing its role both in supporting market conditions and in beating up on the heads of state or government to get them to behave more responsibly. So what did the European heads of state or government add in their configuration as the European Council? They had a really quick meeting, and what they did is they agreed to do what the Eurogroup had promised to do on the 9th of April. We've talked about it before, the three important safety nets for workers, businesses, and sovereigns. Remember, though, that these safety nets exist largely in the form of guarantees that are going to be put up by European institutions that they believe they'll be able to leverage into large lending facilities. So a lot of that 540 billion euros remains to be seen. A significant chunk of it, 240, comes from the European Stability Mechanism, and that's something that we're going to have to talk about later. It's still very controversial in Italy, and the details need to be worked out. So they've agreed to give us something, but there are still big questions to be answered. And the most important piece of information in that regard is that those questions will be answered by the 1st of June when these programs are operational. So they're at least making progress. They've also agreed to establish a recovery fund that is needed and urgent. And in agreeing to do so, what they really did was agree to ask the Commission to go out and figure out what they need to do and to clarify the link. And I think this is a meaningfully vague phrasing, to clarify the link between this recovery fund that they've promised and the multi-annual financial framework. And when they say clarify the link, you have to wonder if that means there may not be a link at all. Recall the plan from the European Commission is to use the own resources that are available to it through the multi-annual financial framework to guarantee a large amount of lending. If they expand the multi-annual financial framework from 1.1% of GNI up to 2%, then that could give them a significant guarantee volume that they could use, somewhere around 350 billion euros. The question is whether they can actually leverage that up 3 times to get a trillion euros or 1.5 trillion euros, depending on the leverage ratio they're able to create, 1.5 trillion euros of fresh loans that they could offer to the member states. Under what terms, how much of that could be grants, all remains to be seen. So the Commission proposal will be drafted in early to mid-May. It'll be deliberated by the Eurogroup and other configurations of the Council, and then eventually presented again to the European Council in June. So this is what the European Council has added. What did the markets think about this? Well, let's be honest, the markets were up and down on these things. The downs came in response to the ECB's action. So you see that that growing pressure on Italy, and then the ECB it starts to leak that it's going to change the collateral rules. And once it does announce the change in the collateral rules, which came at the close of trading on Wednesday, when the markets opened on Thursday, then there was a sharp correction, and that sharp correction actually lasted through most of the day. Then there was the whole jawboning of the European Council, followed by the European Council's decision on Thursday. And the European Council's decision on Thursday wasn't greeted warmly by the markets, but the markets eventually calmed down as Friday progressed. I think part of the reason the markets calmed down is because Moody's had already declared that it wasn't going to revisit the Italian ratings prematurely. Standard & Poor's was supposed to deliver a ratings decision on Friday, and in the end decided not to change its ratings. So in that sense, some of the pressure has come off, and that's been very useful. But I suspect if you look at these numbers for the spread, I suspect that last week was an expensive week in terms of the pandemic emergency purchasing program. So we'll have to wait to see what the numbers look like on Monday when the ECB tells us just how much cumulatively they've spent. Remember, the baseline from last week was 70 billion, so the delta will be whatever the new number is minus 70, and that'll give you a sense of how quickly they're moving. The overall envelope is 750. It's clear that's not going to make it to the end of the year. There's already chatter in the markets that they're going to expand the envelope somehow and widen the program. There's even some speculation that they might do that at the next European Central Bank monetary policy meeting, which takes place next week. So we could see action on this very quickly. I doubt we'll see action on this very quickly, but it's a possibility. What does this mean for Italy? Well, part of the answer lies in the lowering of the spread on Friday. You saw how it really came down. That happened because it came clear that the parliamentary majority would not split over the agreement. There was a movement by the Brothers of Italy to put a confidence motion against the Minister of Economics and Finance, Roberto Gualtieri. That movement did not split the governing majority, but split the opposition instead, and Silvio Berlusconi's Forza Italia voted in favor of, or voted against the motion. The fact of the matter is that Beppe Grillo, the spiritual leader or whatever he is of the Five-Star Movement, weighed in and suggested that they should be more reasonable. Now it seems that Luigi Di Maio, and for some reason I've written it as Miao, but it's Di Maio, Luigi Di Maio, the one-time leader of the Five-Star Movement, is now on record as saying that any ESM program, they'll look at the details rather than rejecting it outright, which considers a big concession on his part. And the implication is that Italy could turn out to be more reasonable in terms of accessing this lending facility than Italian rhetoric has suggested, right? And that makes sense when you remember that big number that we looked at before, the really big number for net financing requirements that they're going to have. They could benefit a lot if they were able to access some kind of alternative lending source that didn't have to be them issuing their own paper. I guess the question is whether if Italy is going to be reasonable and look at the European Stability Mechanism credit line, then should we expect Europe to be reasonable as well? Recall I don't know why I put EMS. The ESM does have one condition to any funding, which is what you see at the bottom of your screen, which is that the only requirement to access the credit will be that the Euro area member state requesting support would commit to use the credit line to support domestic financing of direct and indirect healthcare, cure, prevention, and prevention-related costs due to the COVID-19 crisis. The total amount that they have available is up to 2% of GDP. If you pull those numbers that we had previously, that works out to be something in the neighborhood, in the ballpark of about 34 billion for Italy. But does it really? 34 billion sounds like an awful lot of money to depend on what you define as healthcare right? And so I went into the economic and financial planning document to look at exactly how much Italy spends on healthcare related to the COVID-19 crisis. And the big table that you see on your right is the table that has a top line list for healthcare costs. And the amount of money that they're expecting to spend is 1/10 of the amount of money available, if that. It's about 2.7 billion euros on healthcare, 2.8 billion euros on healthcare related to COVID-19. There are, of course, many other expenses, but if you go all the way down, you still only get to about 20 billion that they list as directly related to COVID-19. So are those the only expenses that could be covered, right? Even if we put everything together, it still doesn't max out the allotment that the Italians have available to them. Or should we read the smaller chart, which is to your left? And that smaller chart to the left reveals what are the current expenditures of the Italian state on healthcare, which is the line underlined in red. And what you'll see is that they are going to spend about 120 billion on healthcare this year versus 115 billion last year. So the delta is actually pretty large, right? It's about 4 billion because I rounded both ways. The delta is large and it will get larger next year. So is that the amount of money that they can claim, the delta in the healthcare? Can they claim only the 2.7? Can they claim only the 2.7, 2.8 that they list as healthcare costs associated with COVID-19? Or can they claim the total amount that they're allowed to borrow and use that to finance the giant amount of money that they spend on healthcare? I really don't know, and that's why I think the details are so important for them to work out. And there are a lot of details to consider in terms of how the loans are drawn, how long the maturities are, what the rates of interest being charged are. We're going to have to look very closely at what comes out over the next month. The good news for now is that Italy seems to have avoided a crisis, and the markets seem to be relatively calm and reassured by the fact that the government is holding itself together. They're also reassured that the European Council has come to some kind of an agreement. They may not be thrilled with the agreement, but it's better than having no agreement at all. The European Commission is hard at work to figure out how this agreement is going to play out in terms of a recovery effort. They have a roadmap. We know we're going to find out more information soon, so you're going to have to watch this space. And my commitment to you is to provide weekly updates, at least as long as I have access to this Panopto software, to keep you guys informed until you come back for the next school year. Anyway, it was great working with you guys this semester. I've still got the lecture to tape, and once I do that, then we'll be shutting down this little particular operation apart from the current event side. Take care, guys. Bye.